Hello, this is a short introductory video to the website of the newly established Institute of International Monetary Research. My name is Tim Congdon. I'm the director of the new institute, which is an educational charity set up in England in early 2015 and associated with the University of Buckingham. Everyone agrees that the banks were responsible for the Great Recession. They agree that they're responsible in some way or other. But there's very little agreement about exactly how the banks were to blame or not to blame for the Great Recession, the events that happened just a few years ago and which caused so much trauma to the world economy. The argument in this introduction to the website is that the key part of the bank balance sheet in terms of explaining events is the deposits, the bank deposits on the liability side of the bank's balance sheet. Sorry to frighten you if I use words like liabilities, but everybody has some money in their bank. And if the quantity of money changes quickly, either upwards or downwards, there are major effects on the economy. Now, just to show you two parts of this website that introduce these ideas. To my left, there's a chart that shows you the relationship between the rates of growth, the quantity of money on the one hand, and the rate of increase in national income, how much money people receive in incomes, how much they spend, and so on, for the world's 20 largest economies over the last 20 or 30 years. You can see very clearly that those nations that have got high money growth, Turkey, so on, they have also high growth of national income, and also, of course, a lot of inflation. By contrast, the nation with the lowest growth of money in this period, Japan, had very low growth of national income and indeed for some time falling prices. So a very clear relationship between money, dominated by those bank deposits, and the rate of change of national income, and then the change in the price level. Just beneath me, you'll see another little aspect of this website, the interactive world money map. And what you can do here is, you see these currency buttons, these currency icons, you press them, and you get a potted history of what happened to money and national income in these 6 large economies, again in the last 20-30 years. The relationship isn't perfect, not on a short-term basis, year by year, but over the medium term, there is a clear link between the change in national income that's being caused and the change in money, what's happening in the banking system. The purpose of this institute is to analyse the relationship between banking systems, on the one hand, the rate of growth, and then macroeconomic outcomes on the other. The larger intention of this institute is to help everybody, the people in universities, people in government, people in think tanks and so on, to understand this relationship in order that we can avoid some of these huge fluctuations in economic activity, the kind of thing that we went through in the Great Recession a few years ago. Thank you.